Hello and welcome to our lesson 7. In our lesson 6, we are looking at financial analysis and financial market. So under that, we looked at uses of ratios and we were able to mention different uses of ratios. So in our lesson 7, we'll be looking at classification of ratios. So that is liquidity, profitability, dividend, and shareholders. So before we look at how ratios are classified, let us look at ratio analysis. So when we talk of ratio analysis, it's just another way of avoiding the problems involved in comparing companies of different sizes. Yes, so maybe you can continue and say such ratios are ways of comparing and investing the relationships between different pieces of financial information. So in our next slides, we'll cover more classification of ratios. So when you talk of classification of ratios, we can see here ratios are classified into 5. So the first one is short-term solvents or liquidity ratios. The second one is long-term solvents or financial leverage ratios. Third one is asset management or turnover ratios. Fourth is profitability ratios. And the last one is market value ratios. So we'll go one by one and start looking at the first classification of ratios, that is short-term solvent. So that is so under classification of ratios, we'll be also calculating those ratios that we will identify under the different categories of ratios. So under this, we'll consider each of these in turn. So when you talk of, we'll consider each of these in turn. So the turn considers the different classification of ratios that we have mentioned above. So in calculating the ratios, there is a table below that we'll consider. So that is in calculating these ratios for XYZ. So we'll be looking at a balance sheet of XYZ. So that is, we'll use the ending balance sheet of 2022, or in case let us say maybe that is 2021 figures unless explicitly stated. Also notice that the various ratios are italicized to indicate which numbers come from the income statement and which come from the balance sheet. So this is the table that we'll consider in calculating the ratios. So as you can see, so let's look at the table. Yes, so this is the table that we'll consider when looking at those classification of ratios. So as you can see, here is the table of XYZ organization. So this is assets. So this is the column of assets, column of 2021, and column of 2022. So you can see here. So we have what? We have current assets, we have fixed assets, we have liabilities and owner's equity. So under liabilities and owner's equity, you can see we have what? Current liabilities, which is always under liabilities. And also under here, so this is long term. So this is long term liabilities. So under long term liabilities, we have what? Owner's equity and what? Common stock and paid in surplus. So also under long-term liability, we have what? Retained earnings. So here we'll be looking at the total, and maybe this one is not visible, but this is total liabilities and owner's equity. So as you can see here are the figures. So maybe this is cash 84, 2021, and 2022 98. So and more. So you can see here is the total of current assets. Yes, here is the total of fixed assets 2021, here is the total of current liabilities, that is 2021, and here is the total of retained earnings. So we'll use this table to look at the different classification of ratios as we have mentioned above. Okay, so the first classification of ratios was short-term solvents. So when we talk of short-term solvents, these are used to gauge the company's ability to settle its current obligation as and when they fall due. So that they try to ascertain the relationship between the company's current assets and its current liabilities. As the name suggests, short-term solvency ratios as a group are intended to provide information about a firm's liquidity, and, and these ratios are sometimes called liquidity measures. So you can go on and say the primary concern in the firm's ability to pay its bills over the short run without undue stress. Consequently, these ratios focus on current assets and current liabilities. So we'll go ahead and look at the examples of ratios under short-term solvents. So this is examples of short-term solvent ratio. So as we can see, here is the first ratio under short term. So this is the current ratio. So current ratio, this is used to gauge the company's quantity of its current assets to its current liabilities. So we can say it compares between current assets and current liability. So when we talk of the formula used in calculating current ratio is, so we can see here, current ratio is equals to current assets over current liabilities. So when you look at our table above, as we had seen, you will get current assets was 642, current liabilities was 1074. So when you divide, you will get this. So under the table, you will get that the XYZ 2021 current ratio was 0.5978 times. So let us look at the second example of ratios under solvent. So the second one is quick ratio. So let me get yes, the second one is quick ratio. So maybe you can briefly look at the definition. So you can see here this ratio measures the quality of the company's current and its current liabilities. An asset is said to be liquid if it is either in cash form or can be converted into cash without any loss in value whatsoever. So we can go ahead and look at the example calculation of quick ratio. So here is how it is calculated. So quick ratio is equals to current assets minus inventory divide by current liability. So when you look at our table, you will get that the current assets was 642, inventory, which is under current asset, is 393, and then current liabilities is 1074. So when you do this calculation, you will get the answer is 0.2318 times. So that is the second ratio under short-term solvent. Let us look at the third ratio. So the third ratio is cash ratio. So when you talk of cash ratio, the cash ratio indicates to creditors, analysts, and investors the percentage of a company's current liabilities that cash and cash equivalents will cover. So let us look at the formula of calculating cash ratio. So you can see cash ratio is equals to cash over current liabilities. So cash is under current assets in our table. So maybe in our table cash was 84, and then current liabilities is 1074. So when you divide you get the cash ratio is 0.0781 times. So after looking at the short-term solvent ratios, let us look at the second classification of ratios, which is long-term solvent measures ratios. So definition of long-term solvent measures ratios is, so maybe we can say long-term solvent ratios are intended to address the firm's long-run ability to meet its obligations, or more generally, its financial leverage. These ratios are sometimes called financial leverage ratios or just leverage ratios. So, under these long-term solvent measures ratios, we'll consider three commonly used measures and some variations. So, here is the example of long-term solvent ratios. So, the first one is total debt ratio. So, when we talk of total debt ratio, the total debt ratio takes into account all debts of all maturities to creditors. It can be defined in several ways. The easiest of which is, so here you'll be looking at the formula used to calculate the total debt ratio, where we get that total debt ratio is equals to total assets minus total equity over total assets. So maybe you can look the figures on the table we provided above. So maybe total assets was 3373, total equity that is 2299, and then total assets that is 3373. So when you do this calculation, you get the answer is 0.3174 times. So that is the first example under long-term solvent ratios. Let us look at our second example. So as you can see, our second example is time interested and ratio. So when you talk of time interested and ratio, it measures a company's ability to cover its interest obligation with its operating income. A higher time interest and ratio indicates better financial health and a stronger ability to meet interest payments. So let us look at the formula of calculating the ratio. So its formula is, so when you talk of time interest and ratio, equal to earnings before interest and taxes over interest expense. But then when you look at our table above, we did not have taxes and also we did not have expenses. So maybe we won't do the calculation of it because in our table we don't have the taxes and also we don't have the figure showing the expenses covered in the year 2021 and the year 2022. Maybe let me, yes. So when you check our table, when you look at our table, there's no column showing, there's no row showing the figure of taxes and expenses. So we'll skip it, we'll skip the calculation. So maybe we can go ahead and look at another example of long-term solvent ratios. Okay, so we're looking at this one and we said because taxes and expenses have not been covered in our table, we'll skip the calculation. But maybe you can master the formula used in calculating that ratio. So let's go ahead. So you should know that under the classification of ratios, we had 5 classification of ratios. So ratios were classified into 5. The first one was short term. Yes, the first one was short term solvent. The second one was long-term solvency. So the third one is asset management or turnover measures ratios. So when you talk of asset management measures, assess how efficiently a company uses its assets to generate revenue. So when you talk of key turnover ratios under the asset management or turnover measures ratios include, so the first one is total asset turnover. So we can see its formula is net sales. So the formula of calculating total asset turnover ratio is net sales divided by total assets. So the second ratios under this classification is fixed asset turnover. So the formula is net sales divided by net fixed asset. So you can go on and look at the third example of it. So here is the third one. So that is inventory turnover formula, cost of goods sold over average inventory. So when you talk of inventory turnover, shows how quickly a company sells and replaces its inventory. So maybe when you talk of inventory, inventory is as same as stock. So stock and inventory means the same. So high ratio indicates efficient inventory management. So let's look at the fourth ratio. Fourth one is receivable turnover. So you can look at its formula. So that is the formula of calculating receivable turnover is equals to net credit sales over average accounts receivable. So maybe when you talk of this ratio, it measures how efficiently a company collects payment from customers. So maybe you can consider a company like Amazon, company like Nike. So it just measures how efficiently a company collects payment from customers. So again, higher ratio suggests faster collections. So let's go ahead and look at the other classification of ratios. So this is the fourth one. Fourth one is profitability measures. So maybe when we talk of profitability measures, maybe you can consider this. A company operates on funds contributed by its owners and lenders. These parties need sufficient return on their money. For this reason, the efficiency of any company is measured by the amount of profits it makes in a given period of time. For purpose of analyzing these ratios, the profitability of a company can be related to its investment in assets and sales generated. So the following three measures we will discuss in this section are probably the best known and most widely used of all financial ratios. In one form or another, they are intended to measure how efficiently the firm uses its assets and how efficiently the firm manages its operations. So we can look at the ratios under our fourth classification, that is profitability measures. So the first one, so here example of profitability measures ratios. So the first example is gross profit margin. So maybe I'm aware if you did business studies in your high school, or rather your under development studies, you ever heard of gross profit margin. So its formula is revenue minus cost of goods sold divided by revenue multiplied by 100%. So maybe when you talk of this ratio, measures the percentage of revenue remaining after deducting the cost of goods sold. So otherwise, a higher margin indicates better efficiency in production. So the second ratio under this is operating profit margin. So it is formula you can check here. Operating profit margin is equals to operating profit over revenue multiplied by 100%. So when we talk of this ratio, reflects profitability after accounting for operating expenses but before interest and taxes. So maybe we can also see it indicates operational efficiency. So that is operating profit margin. The third ratio under this classification is net profit margin. So net profit margin, it is formula. So you can see net profit margin is equals to net profit over revenue multiplied by 100. So this net profit margin shows the percentage of revenue retained as profit after all expenses, including taxes and interest, maybe in any company, any organization, or in any industry. So maybe this ratio is a crucial measure of overall financial wealth of an organization or a company or any institution that does businesses. So the last ratio under our fourth classification is return on asset. So when you talk of return on asset, its formula is net profit divided by total assets times 100. So maybe when you talk of return of assets, so you consider we have two types of assets. So that is current asset and fixed asset. So when you talk of current asset has examples such as cash, stock, bank, and more. And when we talk of fixed asset, we talk of machinery, we talk of buildings, we talk of vehicle in a company, we talk of plant in a company. So that is fixed asset. So return on asset measures how effectively a company uses its assets to generate profit. So maybe we can go on after looking at this. So this is our last classification of ratios. As you can see, our fifth classification of ratios is market value measures ratio. So when you talk of market value measures ratio, these ratios try to portray the company's dividend policy and thus its abilities to pay reasonable dividends to its shareholders. So maybe we can also talk of, so this final group of measures is based in part on information not necessarily contained in financial statements, the market price per share of the stock. So maybe you can look at this example. So this is our last classification of ratios, which is market value measures, and we'll go ahead and look at examples of ratios under this. So examples of ratios under market value measures ratio. We can see the first one is price to earning ratio. Maybe you can look at its formula. So price to earning ratio equal to market price per share over earning per share. So this ratio indicates how much investors are willing to pay for $1 of earnings. Also, you can talk of a higher ratio suggests growth expectations, while a lower ratio may indicate under evaluation. So the second and the last ratio under market value measures ratio is price to book ratio. So maybe the formula of price to book ratio is equals to market price per share divided by book value per share. So this ratio compares a company's market value to its book value. And also otherwisely you can see a ratio below 1 may indicate an undervalued stock, while above 1 suggests investors' confidence. So in this lesson we have been looking at the classification of ratios, and we have seen different examples of ratios under each classification. So most of the terms that we have used in this lesson we have covered in other lessons. So we talk of lesson 1 to up to lesson 6. So maybe if you have not understood a term we have used in this lesson, you can go back to our lessons and check the definition of the term and how we used it. So we have come to the end of our 7th lesson. Thank you for watching, and let us meet in our next lesson.